Welcome to Remarkable Retail Podcast, our last regular episode of Season 11, but not our last episode in 2025. I'm Michael LeBlanc.
And I'm Steve Dennis.
On this episode, what is consistently one of the most popular episodes of the year-end predictions review, where we review Steve's bold predictions for 2025 and grade them, is Steve Nostradamus, the amazing Kreskin, Penn and Teller, or somewhere in between. We're about to find out, and of course, then we'll be back with what we each found particularly remarkable this week and a look around the corner. By the way, we'll be back on, as I mentioned, Friday with a season finale special bonus episode featuring part 2 of Steve's predictions reckoning, as well as fast-paced recap of his visit to Amazon's grocery analyst day, a bit of our season 12 plans, and a look at the Netflix house, the streamer's new experimental retail concept. Steve, maybe the audience is so big because it's both people who love your work and people who are sometimes skeptical of your prognostications.
Well, it is the most wonderful time of the year, of course, because we are talking about my predictions. But they're fun to do, and when we get to that portion of the program, I'll talk a little bit more about what they're about and how we're going to go about it. But we'll do basically half of them today, and then the other half on our episode on Friday.
Now, you're just back from rainy Seattle, but you will be soon jetting off to a place with a little less humidity. Talk about your upcoming travel in January.
Hopefully. We've teased this, but I'll just give a little bit more detail. So I will be in Abu Dhabi, not Dubai, as I erroneously said several episodes back. They are close, but quite different in many respects. It's the inaugural Shop Talk Lux conference. I did learn, when I originally said yes, I still would have said yes, but I didn't realize that these sessions will actually be outside on the fabulous beach at a fabulous hotel, the Emirates Palace in Abu Dhabi. That's January 27th through the 29th. And I will be on stage 3 times, not once, not twice, but 3 times on the main stage, interviewing Jennifer Wu, who is the chairman and CEO of Lane Crawford Joyce Group. And now many of our listeners probably know about that, but if you don't, Lane Crawford, essentially the biggest luxury fashion house throughout Greater China and some other parts of Asia. So I think that'll be a real interesting discussion. I actually met Jennifer for the first time about 20 years ago when I was in Hong Kong on some business with Neiman Marcus. There's also a talk show format. That's 3 successive interviews focused on experiences that welcome, convert, and connect with customers. And we'll have 3 really great international brands and great executives. Suzanne Santos is the Chief Customer Officer at Aesop. Derek Soldier, the CEO of Shanghai Tang, and Adil Mahbub Khan, the CEO of Liberty of London. So I've already done my pre-calls with all 3 of them. It's going to be a great conversation. Fantastic. Folks should check out some of my store tours that we shot at Liberty of London. By the time people are listening to this, all 3 of them should be up on LinkedIn and on the Remarkable Retail Podcast YouTube page. But there's still time to secure your spot. Check out our 20% off discount on registration in the show notes. And then the last thing I'll be doing, I should have mentioned earlier, is I'll be doing the conference recap at the end of day 3. So it's going to be a busy time, long flight, but I think it'll be a lot of fun.
Let's go from that. Let's get right into the news of the week. It seems the Fed was listening to our interview last week with Mark Zandi. They cut interest rates for the 3rd time. They are expressing some skepticism about the growth in the economy. Talk about it.
Well, 2 things quickly on this, and then one that ties very directly to retail. Yeah, basically they signaled 1 rate cut next year. I think in general, the market has been assuming not only would we get more, we'll talk about this in my predictions a little bit, but not only would we get more rate cuts this year, but perhaps more rate cuts next year. But as folks that follow this would know, the debate here is with slowing growth, rising unemployment, that would tend to suggest cutting rates more. But inflation is obviously an issue. So they have this dual mandate that they're trying to balance. There's a lot of disagreement apparently among the different members of the Fed as to what direction they want to go in. So it's probably anybody's guess at this point as to how this will really look as we go into the year. I would say, though, I guess the main point I wanted to make on this is I sometimes feel like this gets more attention than it deserves. Not that short-term interest rates aren't important, but from the broader economic perspective, it is medium-term and longer-term interest rates that really matter, and cutting short-term interest rates doesn't, as we've actually seen historically doesn't necessarily mean that the longer term rates are going to come down. Why does that matter? Well, most corporate borrowing is tied to medium and long-term rates, lease rates that affect occupancy that retailers pay, home equity loans, and these kinds of things generally aren't so tied to that short-term rate. So the hope that this will be a big game changer for bringing the home market back, for example, I would say isn't very likely. There are other things that are going on that will really move that. Now, this very retail-specific news that's tied to this is Home Depot issued an updated forecast for 2026, Home Depot being quite tied to the overall performance of the home market more broadly. And they said they expected that their comp store sales next year would be flat to up as much as 2%, and that their earnings would be flat to maybe up just 4%. They did talk about an upside case if the housing market were to recover meaningfully. So they did say that that's a possibility.
Sure.
Essentially, they said, we're not really expecting that to happen. So I think it's a little bit more evidence that the home market is perhaps going to tread water for some period of time.
Coming to the end of earnings season, but there's a few big retailers have released some numbers that tell us some things. Take us through it.
Yeah, again, I'll just try to hit on some highlights. So for the most part, we're done with major retailer earnings. There's some that come trailing in, but it's important to remember that this is for the quarter ending on or around October 31st. Costco is kind of the outlier in terms of the timing there. So no real holiday sales. I mean, obviously, some people jump a little bit the season, but the bulk of what happens with the holiday season will be in the next quarter. And we are starting to learn a little bit more about tariff impact, though I think we are starting to see that also be kind of kick the can down the road a little bit. But overall, more support for what we've been talking about, I think, all year, this great concentration. Most of the incremental growth and share gains are going to some of the very big super scale type retailers, or more the kind of special, what I call special, not big, specialty concepts. So great evidence of this. We've heard from Walmart and Amazon already. Costco, North America's third biggest retailer, keeps growing disproportionately and profitably. Year-over-year sales growth up 8.2%. That's both above average comps as well as some new stores.
Fantastic.
Interestingly, particularly as we've seen the e-commerce market not flatten, but decelerate. Their digital sales jumped almost 21%, and their same-day delivery, which is a whole other topic, which I think we may get to with our next episode a bit, is growing even faster. Now, some other big brands were more mixed, and I think more evidence of what we've touched on a few times with this profitless prosperity. By that, I mean sales growth being pretty good, but profits not so much. And we are starting to see some of the tariff hit become more evident. So Victoria's Secret, which is going through a turnaround, been closing some stores, trying to reposition themselves strategically, starting to get some pretty good results. So I think next year will be more evidence. 5% comp, so not way out of proportion, but their trend has definitely been improving. They broke even. They've been losing money. That's better than expected. And their gross margin actually increased. So they've been able to navigate the tariff hit at least pretty well so far. Now, on the other side of the spectrum here, we've got AutoZone. So for some of our international retailers, AutoZone is a huge retailer, mostly in the U.S. and Mexico. They have nearly 8,000 stores. They do almost $20 billion in retail. So we haven't talked about them very much, I don't think, on the pod, but a very important retailer. And they're really in the DIY space. So perhaps some of the things going on in the economy are pushing some business their way. And some evidence of that would be that their revenues grew 8.2%. So that's comp, as well as I think they opened 50 or 60 stores in the quarter. But their profits decreased mostly due to what they called out as a 200 basis points, so 2 full percentage points of gross margin hit from tariffs. So we'll see how they navigate that going forward, because they also suggest it's going to continue to be a pretty big headwind for them. Now, one of our favorite retailers we talk about a lot, and I was really curious to see what their quarter looked like, because I wasn't so sure whether it was going to be good or not. So I'm talking about RH, the brand formerly known as Restoration Hardware. They've been one to watch in my mind for probably 3 reasons, because there's always 3 reasons. We touched on that last week. Very tied to how the home market is doing overall. And as we just talked about, generally speaking, not so great. Very big tariff exposure because a lot of their products come from Asia, though, because the tariffs are relatively new, not quite hitting them all that much yet. But also opening several of these very expensive gallery stores. I think they opened 4 stores in the last quarter, Manhasset, Montreal, Paris, and Detroit, I believe. Turns out they did pretty well. 8% sales growth, not a huge increase in profits, but improved their profit dollars, but also their EBITDA margin is 16%. So pretty healthy. And they made a lot of improvement on reducing their excess inventory. But the thing I wanted to call out, and again, I have recommended many times that people read Gary Freeman's letter quarterly because they're always quite interesting and a little bit spicy, sometimes a lot spicy. But we've got Festivus coming up, the celebration of grievances, and Gary had a bit of a grievance. The airing of the grievances. So I just wanted to briefly read one of the grievances he aired. Quote, I would point out that our share gains on a 2-year basis range from 12 points to 28 points. And he listed actually some of the from some research where they were gaining share. Continuing his quote, we find it fascinating. I'm not sure fascinating is what he really meant. We find it fascinating that the market chooses to reward companies that set remarkably low, thanks Gary, remarkably low expectations and slightly beat them versus setting high expectations as we do and at times miss them while still meaningfully outperforming our industry. So there you go. Moving on to perhaps another not so shy guy tied to this next story, big changes at Lululemon. We talked about several weeks ago, their founder talking smack about Lululemon's less than stellar performance. Chip Wilson, right?
Chip Wilson. Chip Wilson.
Airing his grievances about Lululemon. Well, perhaps
in the Wall Street Journal, in a full-page ad.
In the Wall Street Journal. Now, I don't know that we can tie a straight line from his kvetching and complaining, but Lululemon delivered another weak quarter. Total sales were up 7%, but the Americas were down 2%, and overall comp store sales only up 1%. Operating income decreased. This is a fairly long string at this point of underwhelming performance. In, I'm sure, an unrelated move, Calvin McDonald is stepping down as CEO after 7 years, and he got his performance appraisal. The minute this was announced, the stock went up about 10%. So we wish Calvin...
The market is happy.
Yes, we welcome Calvin success as he pursues other interests and gets to spend more time with his family. He's actually not leaving until, I believe, the end of January, perhaps. So, yeah.
Well, and what I found, of course, following this closely, is a Canadian-based company, a global company, very big hero to us here as a successful Canadian organization, is they did not announce a successor. They announced that they were hiring a headhunter to go find a successor.
Yes.
So take from that what you may, but it does sound like there was no internal candidate who was fit. We don't know that for sure. Yes. Maybe they may come out with that. But
I'm sure our phones will be ringing off the hook.
I was going to say, let's move on. This week in tariff turmoil, lots of interesting things happening both on the ag sector and some other areas in the world of tariffs. Take us through it.
Yeah, just a couple of quick comments to wrap up on some broader trends. So I describe this as the arsonist offering free housing to those whose houses he burned down. So your favorite president, my favorite president, Donald Trump, is maybe going to give $12 billion to soybean farmers. We've talked about this story before. Basically, the soybean market collapsed because of the Trump policy. Now, it's estimated, and really the I shouldn't joke about it because it's been very, very hard on farmers, not just soybean farmers. The estimated tariff impact from the soybean-specific policy is about $40 billion. So $12 billion does not exactly make the soybean farmers home, but there's all sorts of just craziness here. I'm not going to go into all of it, but I don't know. You just have to shake your head at some of the craziness. And just sort of a broader suggestion that maybe the U.S. tariff policy ain't working so well. A lot of this, of course, is targeted. Well, it's targeted against just about everybody on the planet, apparently. But in particular, China. And China hit a all-time record trade surplus despite the U.S. exports being down nearly 19%. So China is finding other markets for its wares as the U.S. Penalizes them. So to the extent we thought, we being Americans, the administration thought they were going to really hurt China, at least so far, not so much. Now, I remember, Michael, I think last week, maybe the week before, you made a comment about some of the things going on with your prime minister and maybe some relief from tariffs. I don't think we've seen anything come out of that. Is that?
There were some rumors of the three, and that's Carney, Sheinbaum, and Trump getting together. The only noise we've heard, and it's hard to sort through, is there's some rumblings that maybe there's separate deals to be cut between Mexico, U.S., Canada, U.S. I think that's just the chattering class. We don't really know. We didn't certainly see anything concrete out of it, or concrete statements, which we sometimes think is good. Less prognostications and less energy coming out of these meetings is probably not a bad thing. Yeah. Let's negotiate behind closed doors and not make giant pronouncements on Truth Social or wherever. So we're kind of not unhappy, but that doesn't mean conversations weren't held and that progress in one way, shape, or form was not made. So keep an eye on that. Let's keep an eye on that together. All right. Well, that's a wrap on the news of the week. Now let's get to our main show, the main event here, which is your review, your grading of your 2025 predictions. Now, regular listeners would be more than familiar with the format of this episode and love it, actually, because it's one of our most popular episodes. But for all those new listeners that we're seeing pop up in our metrics, thank you, everyone who's a new listener. Give us a bit of background on the approach and how you come up with these and what we're doing here today. Yeah,
so I've been doing my annual retail predictions since 2018, so even before the podcast. I've also been taking full account. We're all about accountability here on the Remarkable Retail Podcast of how well I did or didn't do. Now, one of the caveats I always say about predictions is if they're obvious, I don't think they make for good predictions. So try to lean into some things that are maybe not so obvious, though you can decide for yourself the degree to which I accomplished that. This particular year, 2025, I made a dozen core predictions, and then I added 5 wild cards. So the difference between the core and the 5 wild cards were really the wild cards were way more out there, much more risky. So I wouldn't say I had a high degree of confidence that they would come true. So I've sprinkled them in among the dozen because they're kind of related to some things. So you'll hear how that plans or how that unfolds here over the next 20 minutes or so.
Let's kick it off. Number 1, 2025 is a rinse and repeat year. You did put a caveat, a huge caveat, and talk about what that was about and how did you do?
Yeah, so I think coming into the year, there are some people that thought we would see a real boom because of, in the U.S. In particular, this is really more a U.S.-focused commentary, because of the pro-business policies of the Trump administration. Others were maybe not so sanguine about that. I basically thought 2025 was going to look a lot like 2024. Specifically, that meant above trend, historical trend year for retail sales, continued flight to value, or as you like to call it, the stampede to value, largely because of the trading down behavior. And that a lot of that share would go to the so-called, or at least what I like to call the super scalers, Amazon, Walmart, Costco, TJ Maxx, et cetera. And we'd see growth in private brands. Discretionary categories would be mostly weak. So the more discretionary categories, luxury, big ticket home purchases. And yeah, so that was the essence of it. And we're doing drum rolls before the grades or anything, or just.
Well, I would add though, take our minds back in the time tunnel back to when you were making these predictions. We still had some optimism that the U.S. administration more business friendly. And that there'd be some stability and that there'd be a tailwind behind that. So I just added that in as a bit of color commentary. So I don't know, from a drum roll or a scratch of chalkboard on a chalkboard, what do you give yourself as a grade?
I think I did pretty well here. I gave myself an A-. I got the overall patterns right. Strong retail sales, definitely flight to value. Talk a little bit more about a piece of that in a second. And really, luxury and big ticket were pretty much stalled. So if anything, overall retail did even better than I would have expected, again, with my caveat. So the caveat is actually related to my wild card prediction number 1, which was the other thing we knew going into the year, which doesn't fight with what you said, it's just a different flavor, is that Trump was talking about during his election and before he took office about being aggressive with tariffs, being aggressive about mass deportations, being aggressive about tax cuts. And I thought overall that if, in fact, that happened, and, Trump has a mixed track record, shall we say, on doing things that he said. We're, 9 years later waiting for the big, beautiful healthcare plan and getting Mexico to pay for the wall, but some other things he definitely did. You remember
what it was often characterized as take him seriously, not literally.
Right. Yes.
In the analysts would say, just pay attention to the themes, not the actual details.
Yes.
The actual details matter.
Right. So as it turned out, he's definitely went probably even wilder on tariff policies and immigration policy. Tax cuts probably more or less in line with so-called Big Beautiful Bill, which takes effect next year. I guess I got an A on it happening. The huge caveat did happen. But in terms of what I thought might happen from an impact, I thought that the tariff policy would be much more detrimental to progress on sales. The inflation piece of it did reverse course a bit, and interest rates, as we just talked about in the news segment, have stayed a little bit more elevated. So it's kind of a mixed picture here, but I would say I have to grade myself lower because we have not seen the degree of impact on retail sales that and profits that I expected.
All right, number 2, land of the giants. Massive retailers continue to rise above the rest. If you've been listening to our podcast all year, you know that I got to think your grade was pretty high on this one, but take us through it.
Yeah, definitely. So just briefly, we touched on this a little bit in the news segment as well, that for 2024 anyway, Walmart, Amazon, and Costco collectively represented about 17% of retail sales, but captured over 50% of the industry's incremental growth. Now, we don't have the final numbers for the year, obviously, but just looking at what transpired so far, pretty much the same pattern. We'll get a final number, but over 50% of the incremental growth has gone to those 3 retailers. And if you add in TJX, Shein, Temu, you get well over 60%. So, this is largely due to the stampede to value, but also, some of the things we've talked about just the last 2 or 3 episodes, continuing to see these retailers really push on convenience, being able to stay pretty sharp on their pricing overall. So their scale and scope is really helping them. So I gave myself an A. It's also, by the way, as an aside, which I didn't really call out specifically in the prediction, really seems to be true in e-commerce as well. I've seen some estimates as to what percent of e-commerce growth is going to a very small number of players. And by some estimates, it's over 100%. So that obviously means other people are losing ground.
Number 3, U.S. TikTok ban lives to die or gets sold another day. My leg is sore from kicking cans down the road all year on this. We've often said in other episodes we've recorded and then pulled out updates on TikTok. Generally, I think, again, you got this one pretty right.
Well, I think at the beginning of the year, this was a bit more controversial. I was pretty convinced that there was no way U.S. TikTok was going away. That was partially because it's just too important to U.S. consumers, or the U.S. population, I guess, more broadly. And plus, Trump uses it. So, and I think we've learned throughout the year that he's using a lot of things as leverage. I won't get into all the implications of that, but it's what Scott Galloway calls an orgy of corruption. So there's many ways that things might be. I call it a buffet of grift. But anyway, Scott and I can differ on that. But in any event, as I'm sure everybody knows by now, but there are 2 more weeks left in the year, so something could still happen. U.S. TikTok's still around, so I gave myself an A. I think I nailed it. And then the wild card that was associated with this, have to pat myself on the back, is that, well, I can't give myself, I guess it's incomplete, but looking like an A. My wild card prediction was that Trump would help orchestrate a sale to one of his buddies. And I specifically called out Elon Musk and Larry Ellison, or that it might get merged into Truth Social. So I don't think there's any suggestion it could get merged into Truth Social, but there's a lot of suggestion. In fact, it's more or less been disclosed that a group that includes Oracle founder Larry Ellison is the group that they are negotiating with. Now, in true Trump fashion, things get announced like the end of the Ukraine war and some other things. And that we'll have a big, beautiful healthcare plan, as alluded to just moments ago. And then it'll be another 2 weeks before that gets announced. So we have been, I think, in the wait and see mode now for 2-3 months. But A, on the overall prediction, I think A, but incomplete, probably on wildcard number 2.
We'll be right back right after these messages. Promotional support for the show comes from Glass Media. How do you amplify the wow in your stores? With next-level in-store signage and displays from Glass Media. Glass Media boldly challenges the status quo by leveraging its world-class design, engineering, and manufacturing to elevate brand presence and drive both engagement and conversion. Find out why leading brands and retailers worldwide trust Glass Media to make their stores more remarkable. To take your visual merchandising to the next level, go to glass-media.com. Promotional support for the show comes from Find Mine. Top brands like Ann Taylor, Lululemon, and Anita Bing trust Find Mine to increase return on advertising spend and customer lifetime value through on-trend programmatic ads and landing pages, as well as highly personalized, complete-the-look, matching sets, and lookbooks. Whether using AI imagery or your existing product imagery, Find Mine delivers 50% higher ROAS and more loyal, full-price customers. Book a time to meet them at NRF at findmine.com/NRF. So for the next one, I started to get the sense, all the way back to Shop Talk, private briefings at Shop Talk, and then again at Commerce Next in New York, that search was really undergoing much faster than I expected, a real transformation. You had predicted it, but we really started to see, not just indications, but solid information. So take us through your prediction.
Well, the overall prediction was just search reinvention gets momentum. And specifically, by the way, the things that I'm just highlighting here, if you really care to read kind of the fuller description, I wrote a Forbes piece on both parts of this. So welcome to go see that and get a little bit more color commentary. But essentially what this was about was that search functionality would get a major rework as the age of AI agents emerge. I suggested specifically, and this is the part I'll talk about in a second, I kind of missed. Well, 2 parts I think I did not get exactly right. I also suggested that Google's hegemony, so to speak, would be challenged by ChatGPT and some of these other search agents. Not that Google business would fall apart, but we'd start to see it be meaningfully impacted by the end of the year. And that Perplexity and some others, we've had Daydream's founder, Julie Bornstein, on, would start to get much greater awareness and use. I would say I give myself an A-, maybe a B+. And this is a little bit of color here, right? Because like you, I think that the agentic part, AEO versus SEO, has developed even faster than I thought. Essence of this, I definitely got right. But my suggestion that Google would be impacted in a material way by this, definitely no evidence of that, because I think we talked about this a week or 2 ago. Google has put out new iterations of Gemini and released Sora, and their position, maybe their growth is slowing a little bit, but it's hard to say that this is impacting them in a major way. And as you alluded to, just like getting my head around how much change has happened. There are lots of nuances and partnerships with Walmart and things like that I did not have on my radar screen. So, if I'm charitable, I'd say an A-. If I'm a little bit more pushing myself on the nuances around this, I would grade myself a little less.
Well, channeling Mark Zandi from Moody's on our last episode about what he said about the U.S. economy, don't bet against the U.S. economy. I think that my takeaway is don't bet against Google. They're coming storming back. And I really like their AI products. So, and you see some of them on our podcast imagery. I'm using Nano Banano to do some fun stuff. The next one I thought was a bit of a gimme for you because it seemed obvious, but some of your conclusions were less obvious. But talk about retail media. You said it would continue its strong growth. I mean, the profitability of retail media just tells us that. But, take us through your prediction and how it all shook out.
Well, yeah, in some ways it's obvious, but there are definitely some folks that are putting forward the retail media narrative that the growth will start to occur more broadly than it has historically. So for folks that may not know, retail media networks are really dominated by Amazon. I think it has about a 75% share. Walmart is a strong number 2, and then you kind of get into Kroger and just a handful of others to get to the
Home
95%.
Depot does a good job.
Home Depot is growing, emerging. So, but some folks really saw not only that other retailers would start to grow at a disproportionate rate, not that they would supplant the position of Amazon or Walmart and Kroger, but also that physical store or physical in-store media would start to be a bigger opportunity. And I would say overall, this clearly remains dominated by the big players. If you look at the results that Amazon and Walmart in particular speak to on the growth of their retail media networks, 20+%, huge profit contribution to both players. Walmart calls that out a little bit more directly than Amazon does. So the market share is remaining highly concentrated. And I don't see a ton of evidence that in-store is getting a ton of traction. It is small to the total. Don't think we have great numbers as to how much growth we've seen this year, but there haven't been a lot of big announcements. One thing I saw in particular with the Macy's, they made a big deal about their retail media network. It was flat for the year. So they're not riding the tide. And I generally sense that not too many others are. Now we're seeing plenty of experimentation. We'll talk a little bit more about my trip to Amazon in our next episode. But one of the things that Whole Foods Market showcased was, and Amazon in general, for their physical stores, showcasing some of their displays that are featuring some of the So it is happening. It is certainly more than you would have seen a couple years ago, but I think still people are still figuring it out.
Well, it is the holiday season. That means gathering with family, enjoying a great dinner, and press announcements about retail returns. So every year, you predicted retail returns concerns generate lots of heat and noise, but not much light. Talk about that.
This is actually a harder one. And one of the things you think I would have learned by now is when making these predictions, I should be thinking ahead as to how easy it's going to be, or hard in some cases, to really quantify whether this happened or not. And unfortunately, this is one where it's a little harder to do. But, part of the essence of this, just to talk about what this was about, retail returns, as I'm sure most people will know, have been a bane of most retailers' existence. Some more than others, forever, essentially. And because product returns and exchanges are higher online, and because e-commerce has been growing disproportionate to the total, overall return rates have been going up, which means this is a bigger and bigger issue for most retailers. Lots of things have been tried. There are tech solutions that are getting some specific progress, but it is usually tied up in retailers that have tried to tighten up their return policies, usually get big pushback from consumers. So this gets to me a lot of clickbait headlines. There's lots of stories, but I basically felt like there's no big win here. And as far as I can tell, that is still the case. And unfortunately, from this one way of looking at it, as e-commerce continues to grow faster than physical stores, it is very likely that the number will go up. So I gave myself an A overall, but as I said, it's a little bit hard to be super definitive about this. One of the things that I think is an interesting thing, which I did not put in my prediction, but I've now started to see people talk about, is with the pressures from the economy more broadly, but in particular the cost of tariffs, as retailers scramble to try to find ways to offset that impact through cost savings, will they put more focus, though it's hard to imagine retailers aren't putting a lot of focus on this if it's a big issue for their particular business, will they start to say, well, we have got to find a way to offset some of our expenses, and returns and exchanges is an obvious one to go after. But I have not heard of any retailers yet making a big deal about this.
Perhaps a commercial announcement here, but on a practical basis, our sponsor and our presenting sponsor for our podcasting studio at the NRF, Narvar, is a big player in returns. We're going to have them on the podcast talking about what innovations they're bringing. So it is a big focus. There is some innovation happening in and under the waterline, but the technologists are really need to have that focus in place at the retailers to say, look, let's put some steel in our spine here. We really have to get this underway. And it really, when growth starts to slow and EBITDA, there's a percentage of EBITDA, that could be a big deal that you could be back in the coffers. So
the other thing I would quickly add about this is it's a big dissatisfier, right? There's many reasons that people return and exchange products. Sometimes it's the so-called bracketing thing, but a lot of times it's product delivery issues. It's wrong products sent. So I want to just kind of lift up that there's a consumer experience part of this, that it's better to handle this, as well as obviously it can cost a lot of money.
Yeah, and directly. I would lift up your lift up, so to speak. I'll lift up your lift up.
Lots of lifting.
And say that a return well handled is a customer satisfier. Like it is actually helps build satisfaction, not erode satisfaction. So anyway, that's my lift up of your lift up of the lift up. Come see us at the Narvar podcasting studio at the
we will be elevating, apparently.
That's right. All right, that's a wrap on part 1. And reminder, we'll be back Friday for our bonus episode and finish the rest of your prediction analysis. Let's now wrap this episode and get to what was particularly remarkable this week in our minds. Steve, talk about Doug McMillon for a bit.
Well, I'm hoping some of our listeners and viewers would have viewed Mr. McMillon, the outgoing CEO. He did a long interview on CNBC last week. It was really, I don't want to say I got verklempt necessarily, but when you look back on, as we talked about when the announcement came out that he was turning things over to John Furner, he just really reflected on his time at Walmart. There was a lot of fangirling going on the part of the CNBC anchors because the performance of Walmart, CNBC obviously is an investment show. And during Doug's reign there, 8 years, I think it was, the stock performance is unbelievable. We talk about NVIDIA, but it's a short list of major stocks that have just done unbelievably well and just tremendous innovation there. But, the thing so one was just being reminded of that, most of which I knew, but hearing it all kind of put together was very impactful. But the thing, and I would encourage people to go find it, his humility, his stressing leadership values, to me, it was the elements of what he talked about as a leader that was most impressive. It's great financial performance, but I guess you can debate the degree to which, if you're financially focused, that takes care of a lot of things, or if you're focused on the customer, if you're focused on the sales associate. So many people at Walmart came from store level positions into very senior roles at the company. So it's really an amazing story, but it's not so much for the fun facts about Walmart or the stock performance. It's really about the qualities he imbues as a leader. There aren't too many people like him. I think I don't know him personally, but he's a really special guy. And it was really beautiful. I don't use that term so too loosely, but I just found it tremendously inspiring.
Well, in a somewhat similar vein, I wanted to shout out to the remarkable Calvin McDonald. So Calvin is, as we talked about, announced he's leaving Lululemon. I knew Calvin when he was a fast-rising executive at Loblaw. He took on the ignominious role of president of fast-sinking Sears Canada and moved to Sephora, did some great work there.
I forgot that part. Yeah,
that's right. Sephora North America. And then he decided to interrupt his Ironman training with running Lululemon. He's quite an athlete. Yeah. He definitely lives that brand. Under McDonald, Lululemon grew its store base. Now they got 780 stores, international markets, built men's business, expanded new categories, tennis and golf. He had a good run. So I just wanted to hold up Calvin McDonald, and I'm curious to see where he winds up next. Moving on from that, let's talk about what's on your radar screen for the weeks ahead.
Well, I had two hopefully quick things. This is a very U.S.-centric story, so I apologize to our international listeners. But one of the things that I think is going to have a big bearing on the U.S. retail economy, but the economy more broadly, is what happens with healthcare. Now, our international audience probably knows that the U.S. has a very screwed up healthcare system. I think regardless of what side of the aisle you are on, everybody can agree the healthcare system in the United States is not good. The issue is what to do about it. And as we've touched on, I think a couple of times, the big issue is the subsidizations basically for the so-called Obamacare plans or affordable healthcare plans. If this is not resolved and we are getting right to the closing of the window, though I suppose something could happen next year. But the premium change effective January 1st. Last time I checked, January 1st is coming up really quickly. And this affects 22 million Americans who will see their healthcare premiums go up substantially. Numbers from $200 to $300 a month up to as much as $1,000 a month, depending upon where you sit in the income and number of people in your family and the specific plan you choose. So it's very hard to work out how, because this is mostly the subsidies are based upon income. So the people that would be hit by this would be, broadly speaking, I mean, some small business owners like me, like I was on the Affordable Care Act because it was not part of a corporate plan. But anyway, but largely it affects lower income people. Well, I wasn't getting a subsidy, but the main concern, I think, from the economy perspective is people that are already very, very tight economically suddenly having these huge bills. There's also some impact on the quality of or the coverage of healthcare. There are already some facilities that will be closing because they won't have enough patients to basically keep them operational. So, yeah, this is I think, a really, really big deal. And as we record this, the Senate had a chance to vote on this once again, and they did not reach any resolution. So, TBD. The last one, in a totally different vein, is we've talked about Saks Global many, many times. The news value here is twofold. One is holiday, obviously important to just about any retailer. There's a lot of hope that Saks Global, so Saks Fifth Avenue and Neiman Marcus, will be able to have a good holiday season. But the fears are mounting that their overall leverage and business weakness will put them into a very, very difficult situation. But in particular, the news is that Gary Wassner, who runs a company called Hilden, which I'm sure many people will know, but probably others don't. They are a factoring company, so they buy the receivables, finance vendors getting paid. So Gary Wassner, as reported by our friends at Puck, sent out a note or communicated with vendors that they work with that they should not ship product to Saks Global. So now that's not an issue for LVMH and Kering and a few of the very product group. But I don't know. Maybe I'm breaking news here, but if you don't have product, it's difficult to sell product. That's true. Down. That's my serious. That's Steve's masterclass.
If you know nothing else about retail, if you learn nothing else from this podcast,
yes, welcome to my masterclass on retail finance. So now
your TED Talk is you wrap that TED Talk and say, listen, walk away, and you need product on the shelves to make money.
I should point out that at this point, whatever product Neiman's and Saks have in the stores was previously purchased. So this is really going forward. But I would say that if they don't have a good Christmas and they're unable to flow product, particularly going into the spring season, that is not a happy situation.
A little bit of coal in the stocking there to wrap up what's ahead in the next couple of weeks for those folks. As to me, I'll be in Vancouver, lovely Vancouver, next week on the west coast of Canada. I'll be sitting with the one and only Stuart Samuel, who's been on the podcast before, from IGT, a very astute analyst, observer of the grocery business. I'm going to be in Vancouver. I have a new media property called The Feed, powered by Loblaw, Canada's biggest retailer. So we're delving really deep in this podcast into the grocery industry and the people who make it happen, and vendors and analysts like Stuart. So I'm really looking forward to hanging out with Stuart and some other folks while I'm in Vancouver. So if you're in Vancouver, send me a note. I'll be driving around. I'll be doing lots of stuff. I'll be sitting with Hobbs Pickles in Granville Island, for example. And I like me a good pickle. And
that's a deep cut.
I'm going to be meeting Chris from Hobbs Pickles and getting to know how he can make a business out of pickles. So looking forward to that. All right. Well, that's a wrap on this episode. One more reminder, I think our fourth or fifth of the show, that we'll be back with the rest of your prediction analysis, your prediction, how the prediction outcomes in a bonus episode on Friday. So be sure and tune in then.
Thanks for tuning in. To help more retail leaders discover the industry's leading podcast, please drop us that 5-star rating and review on Apple, Spotify, YouTube, or wherever you enjoy your pods. And for more on my strategic advisory services, keynote speaking, best-selling books, and even more retail industry insights, go to stephenpdennis.com.
If you are a brand or service provider looking to take your influence to the next level, reach out to us for sponsorship, advertising, or event partnerships. And if you want to learn more about my own keynote speaking and advisory practice, reach out to me via LinkedIn.